Good afternoon. Welcome. For those of you who don't know me and have not yet met, I'm Dan Meyer, publisher of BizTimes Media. Thank you for attending this webinar on the CARES Act and the PPP. I know it's a busy time for all. I pray that you, your families, your employees, and their families are healthy and well as we navigate our way through this unprecedented time in our history. Healthcare workers and first responders have done an amazing job during this crisis in their tireless and selfless commitment to taking care of the sick and vulnerable. They are the true heroes. We are all certainly in this together, and while the experts are predicting the next couple of weeks may be the most severe in terms of positive cases of the virus and unfortunately deaths, I'm beginning to feel that the light is starting to shine as we look to the future. In addition to the desire to flatten the curve regarding COVID-19 cases, many business leaders like you are looking to the future beyond COVID-19 and strategizing to get their business to thrive in the new normal. Like many of you, serving this region for 25 years has been a value we hold dear at BizTimes. We are passionate about the Milwaukee region and feel a duty to serve others, including you and your company. I know this is a challenging time for many companies. We need your support at this time more than ever, and in turn, we can help you grow your business. Please consider any of these ideas as you begin plans to thrive post-COVID-19. An integrated program using our print and digital offerings to gain access to your prospects during this time of social distancing. Our April 27th digital-only issue offers you the opportunity to symbolically demonstrate your support of diversity and inclusion in Milwaukee with the logo on the cover. Advertising in our June Innovate Wisconsin Manufacturing and Beyond issue puts you in front of the manufacturers throughout the state. In creating and deploying a company CEO digital or video message that provides assurances to the market that you're here looking to the future and are a resource for your customers and other businesses. Have us help you create or deploy sponsored content where you can share your subject matter expertise with the influential business leaders within our community. You could deploy a targeted email campaign to try to convert prospects who have been on the fence since the start of the current crisis. How about sponsoring a webinar or creating a customized webinar? In 3 days, over 900 people registered for this webinar. And many of these ideas combined with the lead generation program will help you move forward and your prospects forward to the sales funnel and help your business thrive post-COVID-19. If you'd like to explore any of these options, reach out to me or our Director of Sales, Linda Crawford, at any time. We welcome the opportunity. And now on to the program, Understanding CARES Act, where we'll have, the main focus will be on the Payroll Protection Program, otherwise known as PPP. I'd like to thank our event partner, the United States SBA, and sponsors, Davison Kilthau and the Horton Group. Our presenters are from the left to the right are Larry Glussman from Davison Kilthau. He's commercial finance and corporate attorney. Dan Mongroven with the Horton Group. He's a vice president in employee benefit solutions. Tony Hopkins, group vice president of advisory solutions with the Horton Group. And Eric Ness with the U.S. Small Business Administration. And sitting in is Shira Apple. Shira is in charge of public affairs and communications with the SBA. In today's program, we're going to tackle these issues regarding the program, how the bill is intended to help small business, how the loan program works for different size firms, how to apply the risks and rewards, what's forgivable and what's not, insurance considerations related to the CARES Act, and then during this whole program, you can submit your questions using the questions tab in the Zoom function. So I'm going to turn it over to Eric Ness and Larry Glussman. They're going to take you through the next several slides and start with the PPP and what is it, what should borrowers know. So Eric and Larry.
Thanks, Dan. I'm Eric Ness. I'm the director of the Small Business Administration. And what we want to do is talk a little bit about what the Paycheck Protection Program is. It's being administered through the SBA. To access it, you have to go through your local lender As you see, it says apply early, first come, first serve. At this present time, we have 349 billion. You may have heard the news that more is being requested. And basically, we're going to go over the qualified expense, and tracking is going to be key. And especially for our small businesses, there is a huge lift that they need to track and make sure, especially what's going on in their payroll area. And we'll talk a little bit about that. Just kind of a heads up of when this program came up. Last Friday, April 3rd, was the first date that the program was available. April 10th, which is this Friday, that's when sole proprietors and independent contractors can come in and will be eligible for the program. Just a little information of where we were as of yesterday. We did about 80.3 billion in lending and to over 301,000 businesses. So just a kind of a heads up of where we are. Thanks.
Next slide.
So who's eligible? What businesses are eligible? As you see here, employees with fewer than 500 employees or otherwise meet SBA's employee size standard. And I think it's good to look specifically at that because there's a number of businesses, if you look under our size standards, like some manufacturing businesses that actually can go up to 1,000 businesses. So we can actually do businesses with more than 500, depending on what industries they are in. And also they've set up alternative size standards for businesses that may be over 500 employees, but need to get in and may not fit in those size standards. And that is a $15 million net worth and the average net income for the last 2 years of $5 million. You also see that we can do 501c3, so our nonprofit entities, sole proprietors, and self-employed, and tribal businesses, and veteran organizations.
I did see a question if the slides are going to be available. Yes, they'll absolutely be available. At the very end, you'll be asked to answer a survey, and I believe the slides will be available either then or soon after then, so we'll make sure that you all get them. More on eligibility.
So one of the challenges we've had, and we've gotten a lot of phone calls from franchise owners, restaurants, and they have multiple restaurants. And of course, the affiliation rule is where we look at all these businesses together and we combine them for the affiliation. What we have done is we did an affiliation waiver for NAICS codes with 72, which basically is our food service and accommodation. And then in that case, we are looking at 500 employees limitation per location. We also have a waiver for the franchise operators. Interesting, how do you calculate employees? Full-time and part-time, and other employees are counted as a full-time employee for the Paycheck Protection Program. Faith-based organizations are eligible, and there are some links. Okay, just kind of a heads up of how this thing works is, what are the terms? So it's a 2-year term. There is not a payment for 6 months. The interest rate is 1%, and the maximum is $10 million per borrower. And this is kind of where we want to spend a little time. What is the qualifying expense? Of course, qualifying expense are the payroll costs, rents, mortgage, interest, utilities. But really, the real focus on this is the payroll cost. And what is a payroll cost? You saw that the costs include insurance premium, wages, vacation days, sick pay, qualified leave, wages, qualified sick leave. We're going to get into a little of that because a part of that doesn't qualify because there are some advantages through the Family First Response Act, and so we can't really double dip. But I do want to mention a couple other things too. We talked about insurance, we talked about retirement. state and local taxes assessed by employee. And also, we just had a question and answer where we actually we won't reduce it for federal tax, also imposed on the employee, not on the business, but on the employee. And then for sole proprietorships, we're looking at wages, commissions, earnings, income, net from self-employment. So basically, this is kind of the meat of this whole program is what is payroll and getting that documented correctly.
Next slide.
So here's the calculations, and basically when you're going for this program, if you go on sba.gov, and I think we're going to be sharing the link, we have a payment protection program kind of a website that sets up what's needed. So as a small business, you're going to need form 2483, and a part of that is calculating what the borrower's average aggregated monthly payroll costs. So one of the ways to do that is using your previous 12 months or calendar year, and that's for a business that's been in business for over a year. So you have 2019 to go off of. Another way to look at it is, say you're a seasonal business, you can actually go through February 15th, and actually a change has also been made, so you could use March 1st through June 30th to come up with that average payroll cost. And of course, remember, we went over kind of all the things that could be in that payroll. And then if you haven't been in business, let's see, if you can actually go to January 1st through February 29th to come up with that average payroll cost. Interesting, it says payroll costs are limited to the first 100,000 in cash compensation earned by the employee, not to be cash benefits. So let's kind of go over that. So if you did have somebody say they were getting $150,000, when you do your calculations with your number of employees, you would need to reduce that calculations by 50,000. Interesting though, too, on that 100,000, you can actually add in on that employee if you're paying their retirement, their insurance, state and local taxes. So that also can be added into that $100,000 amount. And of course, I think they've gone through a lot of the non-cash benefits that can be put in. So yeah, here's where you hit the qualified sick leave. And that basically, and we do have a question and answer on that, but that's if you're getting a credit that is being allowed from the Families First Response Act, then this would be ineligible.
Forgiveness terms, how does that work?
So this is really going to be focused on payroll costs. Now, you saw when you did the calculation, you did 2.5 times your payroll. The 5 is the 25%. So basically, your payroll cost has to cover at least 75% for you to get this loan forgiven. And so basically, we have rent, mortgage, interest, utilities that can be paid, but really you need to be focusing on payroll costs, and that can be a part of the 25%. Larry, do you have any comments on that specific thing?
Thanks. This is Larry Glussman. I'm a lawyer at Davis & Keelthau, and I work in the commercial finance, real estate, and corporate world. So we've been getting an awful lot of calls from both our borrowers and our lenders. We had an interesting question that was posed to us. We don't know the answer to it, but in terms of the rent costs, questions have been asked as to whether that rent could be for equipment that's necessary for the business. It seems as though the intent of it is likely for traditional rent, to rent a space, but that's something that folks are looking at. just to point out that it's only mortgage interest, not the principal payments, and that utilities do include what you think of as traditional utilities, but they also include phone and internet, which is becoming ever more important for folks these days. And we're going to get to it shortly, but the 25% guidance in terms of what payroll costs, the fact that no more than 25% of these expenditures are supposed to go towards non-payroll costs will come into play when we look at some of the forgiveness questions. So I guess we're on that page right now. There is still further guidance that will be issued on the forgiveness piece. What's essentially going to happen is at the end of, I guess after June 30th, you'll make a submission to your lender requesting forgiveness of all or a portion of the loan. And then the lender is going to have 60 days to process that. And so there isn't complete guidance on that yet, although we do expect that obviously I believe that it's going to be within the 30-day period so 30 days from the enactment of the law, which was about a week ago. In any event, there are two different categories or two different ways to look at how forgiveness might be reduced. If your head count goes down, and there's a formula for that, and then if your payroll costs go down. And so this is what I was alluding to before. Given that Treasury has now indicated that they'd like no more than 25% of this to go to non-payroll expense, there was a safe harbor for forgiveness that allows you to reduce wages by up to 25%, and for that to not have any impact on the forgiveness determination. The question is whether that ultimately will mean that folks, if they reduce their payrolls by 25%, they won't have a forgiveness issue, but they won't have a way to use up all the money that they've borrowed. Because if they're not supposed to use more than 25% of it for non-payroll costs, that's going to leave a portion that isn't going to payroll, because those costs, if all things were equal, those costs would have gone down by 25%. And so we are cautioning employers to be careful about that. It's great that you're going to keep folks fully employed, even if you do have to make a temporary reduction in salary. But it's imperative that you keep that money segregated, because in the event that it's not forgivable, you don't want to you can't spend it on anything that it's not eligible for, and you're going to have to give it back. And then there's a separate category. There's been a sort of a lot, I guess we've addressed it in the prior slides, but there's this separate category of there was some discussion about what went into the $100,000 compensation. I would point out that seems just about every day the Treasury and SBA come out with a slightly longer list of FAQs that we're going to have a link for you to go to. But they did deal with that question very helpfully, and gave us, as Eric said before, flexibility to include certain things that wouldn't specifically be considered salary. They're excluded from the compensation figure. So it's $100,000 essentially in raw salary, and those other benefits that we talked about before let you exceed that number. So the treatment of forgiveness question does come up. Ordinarily, any debt forgiveness is treated as cancellation of indebtedness by the IRS, and that would ordinarily make it taxable as income. There has been a waiver. Well, it will be treated that way, but there is a waiver that's in place so that even though it would be gross income, it will not be considered that for these purposes. You will still, even if the entire amount of your loan is forgiven, you will still have to pay the 1% interest along the way. There is no prepayment penalty, and then there's a dovetail with the economic injury loan program, the EIDL program, which maybe Eric, you'd like to address.
Yeah, so interesting. If your EIDL loan is for payroll, then this statement is correct, that you will have to pay it back, and they'll reduce it. And if you have the forgiveness of the $10,000, that your PPP loan would be reduced. If it's not, then it's your choice. So basically, you know, if you had an idle loan and you had it for payroll, you have to pay it back. If not, you don't have to. So that's it. Okay, so let's see. So I wanted to mention a couple other things that are happening at the SBA. Of course, we just talked about the economic injury disaster loan, and that you may refinance that, or if you use it for payroll, you will have to refinance it with the PPP program. But SBA also is paying the principal and interest on 7A and 504 microloans for the current loans for the next 6 months. So if you do have a 7A, a 504, or an SBA microloan, we are paying your payments for the next 6 months. And going forward, SBA will also automatically pay principal, interest, and fees for new 7A, 504, and microloans issued prior to September 27th, 2020. So basically, if you want an SBA loan, you can get that, and we will pay your next 6 payments.
And before we get to the next slide, I just want to chime in quickly on that. Both lenders and borrowers alike are really, well, for sure the borrowers are elated when they learn that that the 6-month payment is available from the SBA. So if you are fortunate enough or wise enough to be in one of these SBA products already, it's really, I mean, we've almost had folks in tears when they find out that this is something that's available to them. It's a great benefit and something that I think is lost on folks as they're just looking at the PPP program itself. Thanks.
So if one of you want to hit the highlights of this slide.
I believe Eric may be muted.
You're correct, I am. So the loans are 100% guaranteed by the SBA from the lender's perspective. There are no guarantee fees on this program. The borrower is basically the lender will work with and verify the borrower's operation and monthly payroll. So they will take a look at, but really it's the borrower or the small businesses, they are providing the information to make this happen. So the lender will take a look and do a cursory check to make sure that he or she thinks it's correct. The loans may be sold on the secondary market. Processing fees available are based on the loan balance, and see, I think I have that right here. So basically, we are paying lenders for them to process the loan. I think for 350,000 or less, it's 5%. 350 to 2 million, it's 3%, and over 2 million is 1%. And if there are agent fees that are required here, the lenders are paying it out of their portion. Back to the lenders, we're expecting the lenders to perform a good faith review. So, and another question, I know a challenge that some of our lenders are having in the state is getting the online to be able to do E-Tran. We're working with a lot of lenders, and I would encourage lenders who are having issues to email us. We are working with our DC office to try to get our lenders here in Wisconsin who haven't used the E-Tran program for a bit to get them unlocked so they can make those loans.
So Larry, perhaps you can hit this slide and the next one.
Sure. Is it possible we can just move back for one? Thanks
Absolutely.
so much. So the set of bullet points, the last 4 or 5 points, all come directly from this SBA PPP FAQ, the most recent version of which just issued today with another couple answers on it. So I really recommend that folks go there. Over the last week and a half, as lawyers and working with accountants and businesses and bankers, there have been a lot of questions, obviously, as a lot of brain power has been put to this. And the answers that we've gotten have done two things. They've given more clarity, which is clearly important for everyone, but they've also helped to give us a flavor of whether we were headed in the right direction with some of our analysis. And it's been reassuring to see that by and large, that has been the case. So it seems as though everyone is trying to act reasonably here to move things forward as fast as possible. I just wanted to key in on the last bullet point there, which is essentially a grandfather clause. So folks are entitled to rely on whatever laws and rules and guidance exist at the time of their application, since those are ever evolving. And if you have submitted an application, but it has not been processed yet, and there's something in this guidance or any future guidance that would cause you to want to revise your application based on that new guidance, you will be able to do that. So this is incredibly important because it's going to allow folks, it has allowed folks to move forward based on what they know, not have to wait and hesitate based on what they don't know. Thanks. So just real quickly, and we're not going to spend a lot of time on this, but again, there are a package of things that are available, not just through the SBA, they're in the CARES Act, and they're also in some other places, but there is an employee retention credit that's available. And just a caveat here, as we've been saying all along, this portion, what you receive there, you can't use towards the PPP. And then the FFCRA is more is another is an act that a law that came out before the CARES Act did. And again, there's guidance that's been issued just on April 1st by the IRS to help folks understand how that refundable tax credit is going to work, and that's on Form 7200.
So I'm going to turn it over to Dan Mongovin with the Horton Group. Dan?
Thank you, Dan. Good afternoon, everybody. This is Dan Mongovin with the Horton Group. We are an insurance, employee benefits, and risk advisory firm, and my colleague and I, Tony Hopkins, are going to chime in for a little bit on these next few slides. Many of you on the call own a business, run a business, or have financial oversight of a business, and therefore likely have some oversight of the insurance that your business might have, either the employee benefits and health insurance or the property and casualty workers' compensation insurance needs of that business. And the CARES Act, the PPP, the COVID epidemic, this all sort of tangentially runs together, and we thought it would be appropriate to just give you all a quick update on what we're seeing from an insurance and risk management perspective out in the marketplace. So just a couple of quick slides. You've likely heard or seen that just about all medical insurance carriers are waiving any member cost share that exists for COVID relating testing. So that's co-pays, deductibles, co-insurance needs that a person might have to pay out of their pocket for COVID related testing. Some insurance companies are also waiving that cost share for COVID related treatments. I would particularly caution self-funded employers who effectively pay claims for their employees themselves versus being fully insured. Those self-funded employers on the call need to be sure to be communicating with their third-party administrators and their stop-loss carriers as far as how they want to handle COVID-related treatments particularly. And if you haven't had these discussions yet, I'd encourage you to have these discussions very soon. Another interesting tidbit that's come out through all of this is telehealth. That's when you phone into a doctor, telemedicine, teledoc, doctors on demand, lots of different programming out there for telemedicine. Those of you that have high deductible health plans that are health savings account qualified plans, it's important for you to know that typically those health plans, you pay for all of your upfront costs until you satisfy your deductible. But there has been some relaxing of that guidance, and telehealth services for high deductible plans now do not have to satisfy the deductible for high deductible health plans, and those high deductible health plans and the HSA contributions that employees are making into their HSA accounts will still be applicable and legitimate, even though they're going to receive some telehealth services without paying a copay or without having any first dollar expenses prior to meeting their deductible. Another change that's come out of the CARES Act is that over-the-counter medications are now back to being reimbursable by health savings accounts, flexible spending accounts, and health reimbursement arrangements without a prescription drug, without a prescription from your doctor. So we're back to the days where your cotton swabs and Band-Aids and Tylenol and Advil can be run through those pre-tax mechanisms like an FSA or an HSA. Couple other quick points. There's been some additional unemployment benefits that are now available through these laws, an additional $600 per week above the state's normal amount that's allowed. And from a retirement plan perspective, 401k and 403b distributions with some caveats are now allowed without penalty. So if you have those programs through your business, I'd encourage you to talk to some of your advisors that support those causes on your retirement plan side to make sure that you're all squared away there. I would say one of the most asked questions of me in my role as an employee benefit consultant lately has been related to what if we're reducing our workforce, Dan? We're gonna, typically employees that qualify for health insurance have to work full time. They have to work 30 or 40 hours a week to meet benefit eligibility. But we're in a situation now where we're going to do a layoff or a furlough or pull back hours. Can these people still stay eligible for their health insurance? And by and large, the answer is yes. Most insurance companies have relaxed their eligibility requirements and are allowing employers to continue to cover their employees, even if they're laid off or furloughed or working less than full time. Relax these eligibility requirements through at least April or May. Again, self-funded plans, you have a little bit of extra leeway and scrutiny on you. So I would caution you to make sure you're speaking with your third-party administrators and stop-loss vendors to be certain that you don't have any gaps or misunderstandings in how you're expecting to cover your employees while they're maybe not, quote, actively at work or working full-time. I'll kick it over to Tony Hopkins now in the next slide to touch base on some property and casualty implications.
Thank you, Dan, and good afternoon. This is, again, Tony Hopkins, representing the Property and Casualty Division of the Horton Group. Thank you, everybody, for joining us. Getting right into it, risk management decisions. There have been fewer larger risks facing a business than we have facing many companies right here, right now with COVID-19. So we appreciate what the CARES Act and PPP program can bring to some of our clients and some of the businesses out there, quite frankly, to keep them afloat. As there's many very unique discussions going on in what is the priority with a business today. Is it purely preservation? Is it profitability? Is it customer sensitivity? Many of those discussions are happening, and we're all trying to prioritize what's the focus for each unique customer, because everybody's situation is different. The next topic, and seems to be the most frequently asked question in the insurance industry today, at least on the property and casualty side, is that of business interruption insurance. And is this situation covered? I will tell you that, again, we're an insurance broker, but the insurance carrier's position thus far has been that this is largely not going to be covered. There's a couple of different hurdles that a company would have to jump over in order to obtain coverage here, but this is going to be a very, very fluid discussion. Number one, the carriers don't believe that this is a direct physical loss. Now, I think there is a case to be made there if you do have a positive test where you can make the case that one of your employees contaminated the work site, and that could possibly open up some coverage here. The next is there are some virus exclusions present on policies. This really started with the H1N1 SARS. Many years back, carriers started putting a virus exclusion on policies, which could also eliminate coverage. But I would tell you again that there are states such as New Jersey, Ohio, Massachusetts, that are trying to mandate the carriers to pay for some of these business interruption losses. So there is going to be more and more to come. If I were a betting man, I would tell you that there is likely going to be some government intervention here to some degree. The insurance carriers, the insurance brokerage space, and even members of the hospitality and travel industries have co-signed a letter to President Trump and many others called the COVID-19 Business and Employee Continuity and Recovery Fund, where they're trying to get a governmental backstop in order to pay for some of these business income losses to companies. The early projections are that the monetary figures here could be $300 billion a month that companies are losing as a result of this pandemic. So it's a very big deal and one to keep an eye on here very closely. But the number one recommendation that I can tell you is that if you think you have a claim to make a claim. Put records in place, take close account of them, and get your claims in early to not prohibit coverage in the policy or eliminate your rights later on. A couple of the things that you can do right here, right now, is to take advantage of the payment grace periods that many carriers are offering. In fact, most of them are offering a waiver of payment or a delay till at least May or June. So they're not canceling policies if you happen to miss a payment, but I would strongly recommend just communicating with your carriers to make sure that they're aware of what your intentions are. You can also proactively endorse or adjust the exposures on your policy, which could save future money and possibly enhance cash flow, as that's going to be one of the biggest concerns here going forward. To dial back sales and payrolls if your reforecast really has you making some changes here. Workers' compensation premium is also something, and specifically in the state of Wisconsin, if you're going to be paying employees to sit at home, so you can prevent yourself from paying work comp premium on the payroll that you send out to them, there is a $0 rate available, class code 0012. I don't have time to go into many of the details, but there's many landmines found throughout this. So please go ahead and educate yourself more on this. And again, we don't have time to go into too many of the details, but NCCI, which covers most other states outside of Wisconsin, also has a little bit different guidance where you can actually classify these workers working from home or getting paid while they're effectively laid off, can default to a much lower rated class code so that you're not paying premium for employees that aren't working at your business. So it pains me to say this, but as I come to you here in my basement, there are bad actors out there that are attempting to hack into your business. I've already seen it, unfortunately, with some of my clients, but there is an increased cyber risk as we have so many employees quickly spooled up to work remotely, maybe without the protection of multi-factor authentication and VPNs. It just enhances the number of vectors that a business is exposed to cyber risk. So please be aware and be mindful of that, because I would hate for you to fall subject to one of these bad actors during these really tough times. Next is, if you're going to be laying off workers, you should know that employment practices liability policies will likely kick in here if you do happen to fall subject to some litigation as a result. And just know that proactively, many of you have free resources available in your policies to contact an employment attorney, or certainly reach out to Davis and Kilthau here, representing this webinar today. But talking to a free attorney could be great. Many people aren't aware of credit insurance that's available to insure for accounts receivables. Everybody's worried about their customers and slow pay, no pay, bankruptcy situations. Know that I wouldn't recommend buying additional insurance if you're strapped for cash right now, but if you're in an enviable position of having enough cash available, credit insurance could be something to look into, and for the sole purpose of just understanding your customers at a greater level. Even if you don't buy the policy, these credit insurers have a vast amount of resources available to know where the risks are and who's defaulting on their payment. And then finally, I'll kind of end with this, at least for my portion of this, the impact on the property and casualty market. We are in a hard market right now. And even before COVID-19 hit, it was a very disrupted marketplace. So just expect more carrier uncertainty to go on moving forward, and know that many carriers and new underwriters that might be looking to compete for your business, they won't be able to physically come on site here the next couple months and who knows how long. So doing unique things to be able to get their eyes on your business, whether it's through FaceTime or a web chat capability, will likely bring you better alternatives, because we don't know what the underwriters are going to be doing, and they're very conservative by nature. So it's going to be interesting to see how this all plays out. And especially with the uncertainty if the carriers are going to have to pay some of these business income claims in the future or not. So thanks again, and back to you, Dan.
Yeah, as I look to wrap up here, the theme of uncertainty is going to continue from a medical insurance marketplace and what this might mean to your next insurance renewal. I've read, this came out of California, they think insurance premiums there could go up as high as 40%, and I've also read as low as 3%. I think there are just so many unknowns and so many factors to consider, like how much longer is this going to last? Are your employees in Wisconsin, or are they in New York and California and Washington State? Is the vaccine near us, and what are the actual treatment costs for COVID? I've seen, a pneumonia hospitalization typically might be about $20,000 for that entire episode of care. And I've seen some statistics that suggest a severe COVID hospitalization could be $70,000. All very, very difficult to predict. But at the same time, while there are certainly hospitals flooded with COVID cases right now, hospitals are not flooded with these elective procedures that are being put off on hold. Your knee replacements, colonoscopies, mammographies, MRIs, PET scans, stuff that isn't emergent, but rather elective. So I think, interestingly, many employers, while their businesses are being hit from a top-line revenue perspective, their loss ratios on their medical insurance might be relaxed over the next handful of months, which could provide some short-term support, but I would caution you to prepare for the sort of slingshot effect of what's going to happen when we get back to the new normal and your workforce is back taking care of those elective procedures. Specifically, you self-funded employers, I would just caution you to forecast and plan accordingly with the expectation that we will get back to normal, that people will get their knees and hips and shoulders replaced, and those things are expensive, and we need to plan for that. So suffice to say, very fluid environment. We're living in an environment where there are more questions than answers. But we certainly appreciate your time this afternoon, and thehortongroup.com has a wonderful COVID-19 employer resource center and link that I would encourage you to check out for more updates on insurance-related matters to COVID. Thank you.
Thank you very much, Dan. I want to give a shout out to Larry for helping with many of these slides. It's very helpful. So thank you very much. There have been a number of questions before this seminar or webinar, and several since then. And I'll ask the panelists to even ask each other questions, but a couple simple ones are: as an LLC, presumably the loan will be to me personally. Does it affect my credit rating? So if I get the loan, will it affect my credit rating? Does anybody want to take a shot at that one? Got to unmute.
I can take a quick shot. I believe that the question's intent is, will the forgiveness portion of it affect the credit rating ultimately? And if that's the case, it's our belief that it will not. That would seem to, from a policy perspective, undermine what's going on here. But it is a great question, and it is something we're trying to get some further guidance on.
Can an independent contractor apply for the PPP? If so, what documentation is required for forgiveness?
They can apply for the PPP. And so what we're kind of giving guidance is, if it's, the documentation could be payroll processor records, payroll tax filings, Form 1099, MISC, income or expenses from a sole proprietor. For borrowers that do not have any such documentation, the borrower must provide other supporting documents such as bank records sufficient to demonstrate the qualified payroll amount.
So I think I've got a question, actually having gone through this myself, or in the middle of it. What's, Eric probably, or anybody that might know, what's the, as you know it now, what's the process? Your bank has to be able to have a portal to accept the documents. You submit the documents, and then you wait for a period of time. Hopefully your application's been accepted, and then you wait to get in lined with a loan number, and then funds later. I mean, take us from the beginning to the end as you know it now, or as you have heard, and how it will kind of unfold.
So basically, you start out and you naturally do your calculations on your payroll, which leads into your application, and then you fill out a borrower's application, and that's which you can get on sba.gov under our PPP program. So the borrower application will take you through that one calculation that we talked about times the 2.5. Also, you put down what you're going to use the money for, and then there's a number of questions about you and your business, and then you submit that to your lender. Some lenders actually have their own portals with their own applications that you can utilize. Then once that's done, the lender actually puts together an application called, which is 3245, and then they actually submit that to the SBA through a portal to the SBA for the approval process. Once and I think it's been mentioned, this program has come up and operating quite quickly. So not all documents were in place or are in place even now, and we're getting more information day by day. But then there'll be a note and an authorization, and then after the note or authorization is, or the note is signed, then the money can start flowing to that small business to help with their payroll and other expense. And then I believe it's 7 weeks after that, that's when the request for forgiveness of the loan can be sent in.
So Eric, have you heard of others' experiences? Is it, when does the business get the funds? Is it within a week, 2 weeks, a couple days?
Yeah, the act, I think, lays it out 5 days from the approval process. So we're right in the process of trying to get that all worked out and make sure the lenders have the documents they need so that they can do that.
And if I might just chime in really quickly, today there was guidance that lenders can use. They don't have to use the SBA form of promissory note. They can use their own form of note. There was a question about that. And then the 8-week period begins from the date that the lender makes the first disbursement. And that disbursement has to occur no later than 10 calendar days after the date of the loan approval.
Another question, I'm a 501c13. Am I able to receive a loan? Or if a nonprofit receives federal funding, does that have any impact on eligibility for a loan? A couple nonprofit questions.
Forgive me, I'm not sure what a C13 is off the top of my head.
Yeah.
We can certainly answer the question after the seminar, or try to. In any event, the receipt of federal funding, to my understanding, would not have an impact on participation in the program.
Here's a good question. Can or should you apply for the PPP via multiple lenders to increase opportunity to be processed? So let's say your bank isn't able to access it, or maybe they weren't a preferred lender, or maybe that delayed things. How can you, if your particular bank isn't able to do it, do you have options?
Well, first off, you can only apply once for the PPP program. So it's a one and done for the program. And naturally, they can choose what lender they want to utilize. So that's up to the borrower. And on the faith-based organizations, if you go on the SBA.gov website, we actually have like a 3-page fact sheet on faith-based that a faith-based organization can take a look at to help them make that decision.
Might have covered this earlier, but its question was, I thought the PPP was completely forgivable if you met criteria, certain criteria. I saw a Kiplinger letter yesterday that said only 10 weeks of payroll is forgiven if you meet those criteria.
It's 8 weeks.
You can go, Larry.
Sure. I haven't seen the Kiplinger letter. I'm not sure what their source is. All guidance that we're getting is that it's an 8-week period from when you start spending until you're done, up until June 30th, and that the statute makes very clear that there are safe harbors for 100% forgivability, but that there will be deductions and there will be further guidance on that, on exemptions from that, and also just guidance on the forgivability piece itself. As I said before, the most meaningful change in effect that we've seen along the way is this general guidance that they don't want to see more than 25% of this money go for anything other than payroll expenses.
Larry, when we talked yesterday, you were talking about your commercial real estate practice and some of the advantages that exist. Can you elaborate? A lot of our listeners or attendees are owners of real estate and owners of their own buildings. Could you share some insights as to how this may impact them?
Sure. So one of the PPP in itself, in the first instance, is not really designed for the real estate community, specifically for passive ownership without much in the way of employment or employees. So our landlord clients and their banks as well are asking questions of us in terms of how can they take advantage of this program. Our principal advice is to encourage their tenants to get involved, because often the tenants do have employees, and to the extent that the program does allow for 25% of the expenditures to go to non-payroll costs, including payments of rent, then the PPP would be a great source of dollars, at least for the 8-week period that it's currently available for. So that's certainly an important way to get folks involved. Landlords can also talk to they're put in a bit of a trick box, because they can talk to their lenders, because if their tenants don't want to pay or can't pay or have asked for deferrals, then they have to make a decision as to whether they're going to honor that. There's an eviction moratorium at this point. So from a policy perspective and a legal prohibition, they can't move forward on that. Not that they would necessarily want to. It might not, as I say, from a policy perspective, it might not look terribly great or be terribly empathetic. But beyond that, there's a question as to, from the real estate perspective, whether, if the rent isn't received, then technically there may be defaults under the landlord's loan if they have financing on the property. And so we're certainly encouraging a dialogue to the extent that you can get to lenders, that they're not so busy with the PPP piece, that you can talk to them about deferrals yourself as a landlord during this period of time.
There was a question actually from a banker. What is the criteria for determining if a U.S. subsidiary of a foreign-owned company is eligible to receive funds under the PPP?
Interesting. I think.
And if you don't know.
Yes, I actually don't know, but one of the interesting thing is that does come up to is the employees have to have their residence in the U.S. So interesting. It's a sidebar on that one, but I don't specifically know that, so I would need to look that up.
Sure. Can a 4-year-old startup with no employee payroll borrow? What employees borrow? We would like to hire 2 employees if we can get a forgivable loan. Why? I guess they would have to have had those employees first, wouldn't they?
Right. There's a historical look back that we're using to be able to justify the loan.
And our 501c6s, I've never heard of that, entities eligible, 501c6.
We don't believe that C6s are eligible.
We have several employees retire recently or very will shortly. Therefore, our headcount in payroll is lower than the 12-month average we use for the PPP application. How will that affect forgiveness? That's an interesting one. Common probably these days.
I thought Larry and I were talking a little bit about that too yesterday, because that's something you're going to have to strategize as you put this in. I mean, we've heard both sides where it grew and they didn't have the historical, and now in this side they had a historical, and so their payroll may be less than. And I think that's a part of managing this loan application and making sure that and managing the forgiveness, because we know what's going to be required. 75% of the cost have to go to payroll for it to be forgiven.
I've heard this more than a couple times, and Larry, you touched on it, that when businesses do get the funds, I believe it's imperative, smart business practice, to keep the funds separate account, so you don't intermingle old funds and new funds, and to have a straight accounting of what they're being used for. Did you touch on that?
Sure. There is no formal requirement that the funds be segregated. It would be a good business practice to do so, or to be very careful with your accounting, mostly from a forgivability perspective, so that you can properly account and get the full amount of forgivability at the end of the day, but also from a waste, fraud, and abuse perspective, just to make sure that the funds don't somehow get used for a purpose that they're not intended. And the EIDL loans, which we talked about before, are a nice mechanism. It's broader. The interest rate is 3.75 for up to 30 years, or 2.75 if you're a nonprofit. So the money will need to be repaid, but it can be used for broader purposes, more along the lines of working capital.
There's a question about part-time employees. If you've got 2 part-time employees, does that equate to a 1 full-timer? How do part-time employees work into the equation?
Our earlier slide says we're adding them all together, so that would be 2.
That would be 2. Okay. So whether they're part-time, because that was the question, how do we count employees, whether they're part-time or full-time, that's 2. How about franchise owners? Are they eligible or ineligible?
Actually, they are, and because of, especially in the restaurant industry, we've actually taken a big look at that, and yes, they are eligible.
How about sole proprietors? If you've got one employee, is it even worth it?
Well, I mean, you have to run through the numbers, and of course, remember this Friday is when they can send their application in, but it depends on your net income or your earnings or your commissions. You can run through the numbers and see, does it make sense, and is your sales down, or is your income going to go down so it makes sense? So it's an individual decision.
Just a couple more questions before we wrap up. My banker just told me I have to send all W-2s from 2019. We have a small family restaurant with 50 employees. Only about 12 are 32 plus hours per week. The rest are part-timers and kids. How does this qualify? You might have touched on that earlier, right?
Yeah. Larry, do you want to take that one on, or?
Sure. One piece of guidance that we've gotten is that that payroll company records are available. This may not be directly answering the question, but payroll company records are available for use in establishing your payroll figures. So they don't all have to be internal figures from the company. But that's, well, name it. I'm not sure that really answers the question, but I'm certainly happy to answer that offline afterwards, or try to.
I guess this might be the last question. If we needed to already lay off staff due to COVID, how does that affect our PPP application and payroll support? So if they're already laid off and now we're applying for the loan, how would that impact things?
Well, in general, since the measure depends, let's presume this is a company that was in business for all of 2019.
Yeah.
I mean, the measure is going to be either the average monthly payroll for 2019 or the average monthly payroll for the last 12 months. So if the layoffs presumably were rather recent, then you'd be using an old figure that would have incorporated those folks, or potentially, if you wanted to use the running 12-month average, you could use a figure that reflects the fact that they're gone, but that's only going to feed into the 12-month average. So it would bring your number down a little. I guess a lot of this has to do with whether you anticipate that you'll be rehiring or not. We've been generally advising folks to sort of act as a good citizen here and not take more money than they need so that it's available for other folks, but that's a pretty tough thing to make a determination about quickly. But then the next best piece of advice is to, well, if you're going to take the 2.5 times, just again, be very careful that you, as we said before, keep it segregated. And in any event, that you be prepared to give back whatever you don't use.
Dan and Tony, do you have any questions that you could think that you might have missed in your discussion earlier that you could share? Or I know the slides are going to be available for everybody, and I'm sure you are all available if you're contacted by anybody.
Yeah, Dan, this is Tony. I can chime in. I've been seeing a lot of questions on the Q&A regarding workers' compensation premiums and how to take advantage of that. And just in short, yes, you can get credit for reducing some of your payroll here. And it doesn't come back directly in a credit, but the biggest function that goes into workers' compensation premium, which coincidentally makes up the vast majority of most companies' property and casualty premiums in many situations, is payroll. So with a reduction in payroll, if you're reducing capacity, should show up in a reduced premium. To proactively take advantage and expedite the premium, call it return or credit to you, is using the strategy to endorse the policy proactively. If you did have $1 million in payroll, for example, and now your reforecast is showing that that's going to drop drastically to 500,000 or a different number, I would just recommend endorsing your policy now so that your future premium payments are reduced rather than waiting until audit, which generally happens shortly after your policy expires, within 30 to 90 days. So if you want to expedite that, simply endorse your workers' compensation policy proactively, and you can do it as quickly as today.
That's a great idea. Dan, anything from you?
No, nothing specific from me. Thank you, Dan.
Okay. Well, thank you all presenters. Larry from Davis and Kilthau, and Dan and Tony and Eric. This has been helpful. I personally have learned a lot. Hopefully others have that have been in attendance. The attendees, you're going to receive, after you leave the webinar, there's a tab's going to open in your browser with a post-webinar survey. Upon completion, you'll be directed to a web page where you may download the slide deck. The recap video will also be available on the page as soon as it's available for us to add. So if you don't get that, we will make it available. And I want to thank everybody again, and be safe, everybody. Let's look to the future once we're past this COVID-19 situation and get back to the new normal. So thanks again, and have a great rest of the day.
Thanks, everybody. Have a good afternoon.
Take care.
Dan, you'll need to quit Zoom to end the webinar.